Monday, February 20th, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at UK house prices. This is going to be a part 4 in a series that I've done, and it's entitled The Party is Over for UK House Prices. Before I start though, you can probably notice that Rudy's on the sofa. We'll see how that goes. I might have to pause the video if something happens, but he seems to be doing okay. He's pretty calm right now. So not bad for an 11-week puppy to stay there. Hopefully he won't jump. Anyway, as I've said, I've done a series of these, the party's over for UK house prices, and just want to read what I said in the description section of the video of part 1, and this one was from let's see, April 20th last year, so almost a year ago. And let's have a look here again what I said. I said, today we will look at why house prices in the UK should continue to drop in real terms or adjusted for inflation. We do not discount the fact that it might even drop in nominal terms. We will also update our nationwide average house price to gold ratio to see where house prices stand versus real money and where it could go in the future. So I've got a video here from July 2021, UK house prices to gold ratio over the last 100 years, so you can watch that as well. I have another one from actually October 2016, a long time ago. It says the average house price in ounces of gold. I'm going to do an update of that soon, but you can watch that too. And before we go into an article I saw in the Telegraph yesterday that I think is very interesting and shows that even nominal prices now are starting to drop, and that's asking prices, of course. I wanted to show you this tweet. This is from the 17th of February, and it's from Miner of Nassau. I recommend you follow Miner of Nassau. He's an interesting character on Twitter, and this is what he tweeted: GBPCHF, so the British pound versus the Swiss franc, and it's a currency cross that I have an interest in, because when I moved here in the UK to the UK in 1992, I moved from Switzerland, and I negotiated my new work contract for the firm that I came to work for in the city of London, looking at that exchange rate, and at the time £1 bought 2 francs 80. So here's what he's saying: this is how first world turns to third world, and as per Hemingway, the last stage occurs fast. Thought you were smart making money in UK property. Actually, you were just short sterling and didn't even know it. So yeah, 111 now it buys the British pound, almost 1-to-1 with the Swiss franc. What he's trying to say is wealthy individuals who have maybe also a lot of money in Switzerland, they have thought that buying London property was a good deal, but as you see, the Swiss franc is probably the strongest of the fiat currencies over the last 23 years or 25 years, even though the Swiss sold half of their gold reserves in the beginning of this century. The Swiss franc has outperformed the dollar versus gold since 2002. So this is real terms here, and gold, of course, is the ultimate in real terms. So what I'm trying to say here, yes, house prices might not drop that much, but keep an eye on the currency as well. But back to why I think it could fall even in nominal terms. Well, here we are. This is from yesterday in the Telegraph. wealthy homeowners forced to dramatically cut asking prices. 6 in 10 sellers slash prices as housing market downturn deepens. And before I start, that's why I've been looking very closely at the gilt market, because after the Bank of England intervened in September, October, to save the the gilt market, really, because it was melting down, yields have gone back down, but now they're picking back up, and I think they're going to continue to pick up, and that's going to make things, articles like this, even more prominent and more numerous, I would say. So let's get to it. Wealthy homeowners are slashing hundreds of thousands of pounds of their asking prices to sell properties as the downturn hits the top of the housing market. Not surprised it's hitting the top, because it's been the top of the housing market, the expensive properties in West London, Central London, that have really led the way. It's a little bit like the NASDAQ that's led the way in the stock market. 6 in 10 homeowners selling property worth $1 million or more in January were forced to cut their asking prices before they could find a buyer, according to analysis by Hampton's estate agents. This share has soared from 39% in June last year, to hit its highest level since January 2021, when the whole of Britain was in the third COVID lockdown. It was far higher than the 45% average across the whole market. Higher mortgage rates have brought a wave of distressed sales, particularly among landlords in London, just as buyers have seen their borrowing power dramatically reduced. So they explain here why this borrowing power as well has been reduced, and we'll come to it in a minute, and it has everything to do with interest rates, of course. James Waite of John D. Wood Estate Agents gave the example of a house in Chelsea, West London, that had an asking price of $5 million and was reduced to $4.5 million before it went under offer, a drop of $500,000. I still think it's overvalued at 4.5, but it went under offer anyway. He added, in another case, we had a flat that we reduced from $995,000 to $950,000, but that still didn't trigger interest, so we reduced it again to $895,000. Mr. Waite said the property then got multiple offers, but only after a 10% price cut. Sellers are coming to terms with the fact that higher mortgage rates and the cost of living crisis has massively reduced how much buyers can spend. Mr. Waite said, "We have seen a lot of buyers who have had to completely readjust what they can buy based on what they can borrow." He said one customer had received a mortgage offer for $8 million, but the lender had recently cut it by 38%, meaning they can only borrow $5 million. In another case, a buyer who had an offer for $2 million can now only borrow $1.5 million. One thing I would say, if someone was able to get an offer for $8 million, why not just buy a smaller house outright? I just think it's crazy. It's greed. But it also shows that people realize that maybe real rates, they're negative. So if you can borrow a big amount, you're actually in good shape over the long term. If you can keep the payments going, of course, there's always that flip side to things. Just as buying power dwindles, the number of homeowners under pressure to sell quickly is climbing. Mr. Waite said, there is a big issue in the buy-to-let sector, particularly among accidental landlords, as landlords get hit by higher mortgage rates. Buy-to-let investors coming to the end of fixed-rate deals must remortgage at rates that are double what they are used to. David Hill of Marsh & Parsons Estate Agents said, some people are definitely struggling. High mortgage rates mean their profits have diminished rapidly. Gene Jameson of Foxton's estate agents said, a few more landlords are coming in to pick up the distressed landlord stock. They know that because they're buying from a distressed seller, they can knock off 10 or 20%. But there are also distressed sales across the market, Mr. Jameson added. It's absolutely across all our divisions. Maybe not all of them have to sell today, but there are homeowners who can't afford the mortgage rates, and the cost of living crisis mean people are really stretched across everything. So yes, what do I think about all this? Well, it's probably going to get worse for the people who have big mortgages and have bought properties and can't afford it anymore as mortgage rates continue to rise. But it's good for other people who have been frugal, people who have been stacking gold or silver over the years, who have saved even in fiat pounds. I think they will do well, and they will have a lot more bargains coming their way. And so it's not all bad. And I think this is beginning in the high end of the market, but it's going to seep through to the lower end. Hopefully, it will also help younger people who are trying to buy property to be able to afford it, because I think it's still really unaffordable if you compare real wages and salaries to like 30 years ago. It's crazy how much young people have to pay to buy the average house. So yes, the party might be over for UK house prices in real terms and even in nominal terms, but it's not all bad. And things don't go on forever. And I think what we need to keep an eye on is on the UK gilt yields, the government bond yields. And I'm going to put a link to the page that I look at every day, so you can keep an eye on it. And I would click on the particular yield that you might want to follow. For example, click on the 2-year yield and start looking at the charts to see where we're going, where you think the trend is. Become a technical analyst, just like I've been for over 30 years, aside from looking at the fundamentals. So, looks like Rudy is doing okay. Hopefully I didn't speak too soon. But anyway, before we look at the markets, just wanted to talk a little bit about the partners I work with in the precious metals space. Over the years since I started this channel in 2015, many of you have asked me where to buy gold and silver. So what I've done is built relationships with bullion dealers that I have dealt in the past. And I've provided promo codes, referral codes for people who are interested. These bullion dealers that I work with, I trust them 100%. For example, here in the UK, I work with Gold Investments. I started dealing with Simon and Oliver's father back in 2002. It's a family-run business. They've been in business since 1981. So that's Gold Investments. I also have a relationship with Glint. And Glint, of course, is slightly different because they hold your gold in an allocated vault in Switzerland, Brink's vault in Switzerland, and they provide you with a MasterCard through which you can spend your gold. And there's also the GlintPay app. I personally prefer physical, but I do have some Glint. Some people prefer Glint. And recently, I've started working with ITM Trading and Lynette Zhang and her team. They will provide you a free consultation if you've never bought gold. They will help you with strategies on how to preserve your wealth and maybe even increase your wealth through precious metals. And also with Andy Schechtman, I have a relationship in the United States, of course. One final word, don't take my word for granted. Do your own due diligence. Find who you think is the most reputable dealer and a dealer that can give you the best price. But these are just the ones that I like. And if you want to know more about them, there's more details in the description of this video. So it's 8:23 a.m. London time. So let's see where things are this morning. We've got spot gold at 18.46. It's up just over $3. High's been 48 and the low's been 37. Silver is up 12 cents at 21.84. High's been 90, low's 54. Dow futures is down 23 points. NASDAQ 100 futures down 12. S&P 500 is down 4 points, so fairly quiet in the stock markets. To the currencies, sterling is up marginally at 120.50. The euro as well is at 106.98. The dollar is unchanged versus the Japanese yen, 134.16. And the dollar is down 0.2 versus the yuan at 6.86. The Aussie dollar is up 0.5% at 69.08. The dollar is down slightly versus the Canadian, 134.62. And the Kiwi dollar is actually unchanged at 62.41. Look at the general commodities. Platinum is up $6.50, trading around $9.27. We've got WTI crude up 1%, 77.28. Brent is up 1% at 83.54. High-grade copper is up slightly at 4.11. And to finish off, we're going to look at the Treasury market or the government bond market. We'll start with the U.S. market. The 10-year yield is down 1 basis point at 3.82. Let's look at the UK market. We've got the 2-year gilt yield. That's pretty much unchanged at 3.79. It looks like the trend is higher there. And the 2-year yield and the 2-year swap rate in the bond markets and derivatives market, that's what's used for setting a lot of mortgage rates. The 10-year is up just over 1 basis point at 3.53. And the 30-year is up 2 basis points at 3.96. The Japanese bond market is still relatively subdued, calm. They've been able to keep that 10-year JGB yield just below 50. Right now we are at 50 basis points. But I wonder how much QE they've been doing since late last year, because the Bank of Japan started unwinding the balance sheets through QT or quantitative tightening, i.e. selling their bond portfolio. But since, as I said, late last year in December, they've started buying a whole load of JGBs. So they've reversed that. I think they've bought almost like 500 billion, maybe more, dollars of JGBs. So with that, I'm going to wish you all a very good day and a good start to the week. Take care. Bye.